we're diving into an exciting topic that can transform your financial future. We're going to explore 10 profitable investment assets that can help you achieve rapid wealth. Whether you're a seasoned investor or just starting out, this video is packed with valuable insights. Let's dive deeper into our first investment asset, stocks. Stocks have been a cornerstone of wealth building for decades, and understanding how to invest in them can significantly impact your financial future. Here's everything you need to know about investing in stocks. Investing in stocks means buying shares of ownership in a company. When you own a stock, you're entitled to a portion of the company's profits and assets. Here's why stocks are a crucial part of any investment portfolio. Historical performance. Over the long term, the stock market has provided an average annual return of about 7 to 10% after adjusting for inflation. This outperforms many other types of investments. Growth potential. Companies can grow significantly over time, leading to substantial increases in stock prices. For example, early investors in companies like Apple, Amazon, or Tesla have seen their investments grow exponentially. Dividends. Many stocks pay dividends, which are regular payments made to shareholders from a company's earnings. Dividend stocks can provide a steady income stream and are especially attractive during periods of market volatility. There are various types of stocks to consider. Common stocks. Most investors purchase common stocks, which provide voting rights and dividends. These stocks represent the majority of the market and are what most people refer to when they talk about investing in stocks. Preferred stocks. Preferred stocks are a hybrid between stocks and bonds. They offer higher dividend yields and have priority over common stocks in the event of a company's liquidation, but they typically do not come with voting rights. Growth stocks. Growth stocks belong to companies expected to grow at an above-average rate compared to other companies. These are usually reinvesting their earnings to fuel further growth, so they often don't pay dividends. Examples include tech companies like Netflix and Amazon. Value stocks. Value stocks are undervalued by the market, but have strong fundamentals. They often pay dividends and have lower price-to-earnings ratios. Companies like Johnson & Johnson and Procter & Gamble are considered value stocks. Now let's talk about how to invest in stocks. Research and education. Before investing, educate yourself about the stock market, different industries, and individual companies. Websites like Yahoo Finance, MarketWatch, and Bloomberg are excellent resources for research. Choose a brokerage account. To buy stocks, you need a brokerage account. Online brokerages like Robinhood, eTrade, and TD Ameritrade offer user-friendly platforms with educational resources to help you get started. Diversify your portfolio. Don't put all your money into one stock. Diversify your investments across different sectors and industries to mitigate risk. A well-diversified portfolio can protect against significant losses. Invest for the long term. Stock market investing is best suited for long-term goals. The market can be volatile in the short term, but historically, it has trended upward over the long term. Stay patient and avoid the temptation to panic sell during downturns. Investing in stocks can be highly profitable if done wisely. Remember to do thorough research, diversify your portfolio, and stay committed for the long haul. Stocks offer growth potential, dividends, and the opportunity to be a part of innovative companies shaping the future. So, start your stock investment journey today and watch your wealth grow over time. Let's dive deeper into our second investment asset, bonds. Bonds are often considered a safer investment compared to stocks, and they play a crucial role in diversifying your investment portfolio. Here's everything you need to know about investing in bonds. When you invest in bonds, you are essentially lending money to a government, municipality, or corporation. In return, the issuer promises to pay you periodic interest payments and to return the principal amount at maturity. Bonds can be an excellent way to generate steady income and preserve capital. There are various types of bonds to consider. Government bonds. These are issued by national governments. United States Treasury bonds are a popular example, known for their low risk since they are backed by the full faith and credit of the United States government. Other examples include UK gilts and German bunds. Municipal bonds. Issued by local governments or municipalities, these bonds are often used to fund public projects like schools, roads, and hospitals. They come with tax advantages, as the interest earned is often exempt from federal and sometimes state and local taxes. Corporate bonds. Corporations issue bonds to raise capital for various purposes, such as expanding operations or funding new projects. These bonds tend to offer higher yields than government bonds, but come with higher risk, depending on the issuing company's financial health. High-yield junk bonds. These are bonds issued by companies with lower credit ratings. They offer higher interest rates to compensate for the increased risk of default. While riskier, they can be a part of a diversified portfolio for investors seeking higher returns. International bonds. Issued by foreign governments and corporations, these bonds can provide exposure to international markets. They come with additional risks such as currency risk and political risk, but can offer higher yields. Let's break down how bonds work. Face value. The face value, or par value, is the amount the bond will be worth at maturity. It is also the amount the issuer agrees to pay back the bondholder. Coupon rate. The coupon rate is the interest rate that the issuer pays to the bondholder. This interest is typically paid semi-annually. For example, a bond with a $1,000 face value and a 5% coupon rate will pay $50 annually. Maturity date. The maturity date is when the bond's principal amount is due to be repaid. Bonds can have short-term, less than 5 years, medium-term, 5 to 10 years, or long-term, more than 10 years, maturities. Yield. The yield is the return you can expect to earn if you hold the bond until maturity. It can vary based on the bond's price, coupon rate, and time to maturity. Here's how you can invest in bonds. Buy directly from the issuer. You can purchase government bonds directly from the government through platforms like Treasury Direct in the US for corporate and municipal bonds. You can buy them during the initial offering. Buy through a broker. Most bonds are bought and sold through brokers. Online brokerage firms like Fidelity, Charles Schwab, and Vanguard offer a wide selection of bonds. Bond funds. Investing in bond mutual funds or exchange-traded funds, ETFs, provides diversification by pooling money from many investors to buy a variety of bonds. This can reduce risk compared to buying individual bonds. Secondary market. Bonds can also be bought and sold on the secondary market before they mature. The price can fluctuate based on interest rates, credit ratings, and market demand. Investing in bonds can provide a reliable income stream and lower risk compared to stocks. They are an essential part of a diversified investment portfolio. Remember to consider the issuer's credit rating, the bond's maturity, and the interest rate environment before investing. Bonds offer various opportunities, from government and municipal bonds to corporate and high-yield bonds, catering to different risk appetites and investment goals. Now let's explore our third investment asset, real estate. Real estate has long been a popular investment choice, offering multiple ways to generate income and build wealth. From rental properties to real estate investment trusts, REITs, let's dive into the various opportunities available in real estate investing. Investing in real estate involves purchasing property as an investment to generate income rather than using it as a primary residence. Here are some key benefits of investing in real estate. Income generation. Real estate can provide a steady stream of income through rental payments. This is particularly attractive for investors looking for passive income. Appreciation. Properties can increase in value over time, offering capital gains when you decide to sell. Historically, real estate has appreciated in value, although it can vary by market and economic conditions. Tax benefits. Real estate investors can take advantage of various tax benefits, including deductions for mortgage interest, property taxes, operating expenses, and depreciation. Leverage. Real estate allows you to use leverage, meaning you can purchase property with borrowed money. This can amplify your returns, as you can control a large asset with a relatively small investment. There are several ways to invest in real estate. Residential rental properties. Buying residential properties, such as single-family homes, duplexes, or multifamily units, To rent out is a common strategy. This can provide a steady income stream and potential appreciation. Commercial real estate. Commercial properties include office buildings, retail spaces, and industrial properties. These investments often have longer lease agreements and can offer higher income potential compared to residential properties. Vacation rentals. Investing in vacation rentals, such as properties on Airbnb or VRBO, can provide significant income, especially in popular tourist destinations. However, this strategy requires active management and marketing. Real estate investment trusts, REITs. REITs allow you to invest in real estate without owning physical property. They are companies that own and manage income-producing real estate and are traded on major stock exchanges. REITs pay dividends and offer liquidity similar to stocks. Real estate crowdfunding. Platforms like Fundrise and Realty Mogul allow you to invest in real estate projects with as little as $500. This method pools funds from multiple investors to finance real estate ventures, offering exposure to large projects without significant capital. House flipping. Flipping involves buying properties, renovating them, and selling them at a higher price. This can be lucrative, but requires expertise in real estate and construction, as well as the ability to manage costs and timelines effectively. Here's how you can start investing in real estate. Research the market. Understanding the local real estate market is crucial. Look for areas with strong rental demand, job growth, and potential for appreciation. Websites like Zillow, Realtor.com, and Redfin provide valuable market data. Secure financing. Unless you're paying cash, securing financing is a critical step. Get pre-approved for a mortgage to understand your budget and improve your bargaining power when making offers. Choose your investment strategy. Decide which type of real estate investment suits your goals and risk tolerance. Whether it's residential rentals, commercial properties, or REITs, each strategy has its pros and cons. Conduct due diligence. Thoroughly evaluate potential properties by considering factors like location, condition, rental income potential, and expenses. Hiring a real estate agent or an investment advisor can be beneficial. Manage the property. Effective property management is essential for success. You can either manage the property yourself or hire a property management company to handle tasks like tenant screening, maintenance, and rent collection. Investing in real estate can be a powerful way to generate income and build wealth. From residential rentals and commercial properties to REITs and crowdfunding, there are numerous opportunities to suit different investment styles and goals. Remember to research the market, secure proper financing, and manage your properties effectively to maximize your returns. Let's dive deeper into our fourth investment asset, mutual funds. Mutual funds are a popular investment vehicle, especially for those who prefer a hands-off approach. They offer diversification, professional management, and a range of investment options. Here's everything you need to know about investing in mutual funds. Investing in mutual funds means pooling your money with other investors to purchase a diversified portfolio of stocks, bonds, or other securities. These funds are managed by professional fund managers who make investment decisions on behalf of the fund's investors. Here are some key benefits of investing in mutual funds. Diversification. Mutual funds invest in a variety of securities, spreading risk across multiple assets. This diversification helps reduce the impact of poor performance by any single investment. Professional management. Experienced fund managers oversee mutual funds, making decisions based on extensive research and analysis. This professional management can be particularly beneficial for investors who lack the time or expertise to manage their own portfolios. Affordability. Mutual funds allow investors to diversify their portfolios without needing a large amount of capital. With a relatively small investment, you can gain exposure to a wide range of assets. Liquidity. Most mutual funds are highly liquid, meaning you can buy and sell your shares on any business day at the fund's current net asset value, NAV. There are various types of mutual funds to consider. Equity funds. Equity funds, also known as stock funds, invest primarily in stocks. They aim for capital growth and can be categorized by market capitalization, large cap, mid cap, small cap, or investment style, growth, value, blend. Bond funds. Bond funds, or fixed income funds, invest in bonds. These funds provide regular income and are generally less volatile than equity funds. They can be categorized by the types of bonds they invest in, such as government, municipal, or corporate bonds. Money market funds. Money market funds invest in short-term, high-quality debt securities like treasury bills and commercial paper. They aim to provide a safe place for investors to park their money while earning a modest return. Balanced funds. Balanced funds, also known as hybrid funds, invest in a mix of stocks and bonds. They aim to provide a balance of income and capital appreciation, making them suitable for investors seeking a diversified portfolio in a single fund. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500. They offer low fees and consistent performance in line with the market they track. Sector funds. Sector funds focus on specific industries or sectors of the economy, such as technology, healthcare, or real estate. They can offer higher returns, but come with higher risk due to their concentrated exposure. Here's how you can start investing in mutual funds. Define your investment goals. Determine your financial goals, risk tolerance, and investment time horizon. This will help you choose the right type of mutual funds that align with your objectives. Choose a fund. Research and select mutual funds based on factors like performance history, fund manager reputation, fees, and the fund's investment strategy. Websites like Morningstar, Investopedia, and your brokerage platform provide detailed information and ratings for mutual funds. Open an account. To invest in mutual funds, you'll need to open an account with a brokerage firm, bank, or directly with the mutual fund company. Firms like Vanguard, Fidelity, and Charles Schwab offer a wide range of mutual funds and provide online tools for easy account management. Make your investment. Decide how much money you want to invest initially and whether you want to set up automatic contributions. Regular contributions can help build your investment over time and take advantage of dollar-cost averaging. Monitor your investment. Keep track of your mutual fund's performance and make adjustments as needed. Review your investment portfolio periodically to ensure it aligns with your goals and risk tolerance. Investing in mutual funds can be a convenient and effective way to diversify your portfolio, benefit from professional management, and achieve your financial goals. Whether you choose equity funds, bond funds, or index funds, mutual funds offer a range of options to suit different investment styles and risk appetites. Remember to define your goals, choose the right fund, and monitor your investments regularly. Now, let's delve into our fifth investment asset, cryptocurrencies. Cryptocurrencies have taken the financial world by storm, offering a new way to invest and transact. They come with high potential rewards, but also significant risks. Here's everything you need to know about investing in cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They operate on decentralized networks based on blockchain technology, a distributed ledger enforced by a network of computers. Here are some key benefits of investing in cryptocurrencies. High potential returns. Cryptocurrencies have shown significant price appreciation over the past decade. Early adopters of Bitcoin, for instance, have seen substantial returns on their investments. Diversification. Adding cryptocurrencies to your portfolio can provide diversification. Their performance is often uncorrelated with traditional assets like stocks and bonds, potentially reducing overall portfolio risk. Decentralization. Cryptocurrencies operate on decentralized networks, reducing the influence of central banks and governments. This can offer greater financial autonomy and resistance to censorship. Innovation and growth. The cryptocurrency market is rapidly evolving, with new technologies and applications emerging, such as decentralized finance, DeFi, non-fungible tokens, NFTs, and smart contracts. These innovations offer exciting investment opportunities. There are various types of cryptocurrencies to consider. Bitcoin, or BTC. Bitcoin is the first and most well-known cryptocurrency, often referred to as digital gold. It's used as a store of value and a medium of exchange. Ethereum, or ETH. Ethereum is a decentralized platform that enables smart contracts and decentralized applications, dApps. Ether, ETH, is its native cryptocurrency, which is used to power the network. Ripple, or XRP. Ripple is both a platform and a currency. The Ripple network aims to enable fast, low-cost international payments, and XRP is used to facilitate these transactions. Litecoin, or LTC. Created as a lighter version of Bitcoin, Litecoin offers faster transaction times and a different hashing algorithm. Cardano, or ADA. Cardano is a blockchain platform for smart contracts and dApps, aiming to provide a more secure and scalable solution than existing blockchains. Polkadot, or DOT. Polkadot enables different blockchains to interoperate, allowing for the transfer of any type of data or asset across blockchains. Stablecoins. Stablecoins are cryptocurrencies pegged to stable assets like the US dollar or gold. They aim to reduce volatility, making them useful for transactions and savings. Here's how you can start investing in cryptocurrencies. Research thoroughly. Understand the fundamentals of blockchain technology and the specific cryptocurrencies you're interested in. Websites like CoinMarketCap, CoinGecko, and various cryptocurrency news portals provide valuable information. Choose a reliable exchange. To buy and sell cryptocurrencies, you'll need to use a cryptocurrency exchange. Popular exchanges include Coinbase, Binance, Kraken, and Gemini. Ensure the exchange you choose is reputable and secure. Secure your investments. Security is crucial in the cryptocurrency space. Use hardware wallets or secure software wallets to store your cryptocurrencies. Enable two-factor authentication, 2FA, on your exchange accounts and be wary of phishing scams. Diversify your portfolio. Just like with traditional investments, diversification is key. Don't put all your money into a single cryptocurrency. Spread your investments across different assets to mitigate risk. Stay informed and updated. The cryptocurrency market is highly volatile and rapidly changing. Staying informed about market trends, regulatory developments, and technological advancements. Join cryptocurrency communities on platforms like Reddit, Twitter, and specialized forums. Understand the risks. Cryptocurrencies are highly volatile and speculative. Be prepared for significant price fluctuations and understand that you could lose your entire investment. Only invest money you can afford to lose. Investing in cryptocurrencies offers a unique opportunity to participate in a rapidly growing and innovative market. With potential high returns come high risks, so it's essential to research thoroughly, secure your investments, and stay informed. Whether you choose Bitcoin, Ethereum, or other altcoins, cryptocurrencies can add diversity to your portfolio and provide exposure to the future of finance. Now let's explore our sixth investment asset, precious metals, gold and silver. Investing in precious metals like gold and silver can be a good hedge against inflation and market volatility. Let's delve into why these metals are considered valuable assets and how you can start investing in them. Gold and silver have been recognized as valuable commodities for centuries, prized for their beauty, rarity, and practical uses. As investment assets, they offer several advantages that appeal to both individual investors and institutional portfolios. Benefits of investing in gold and silver. Hedge against inflation. One of the primary reasons investors turn to precious metals is their ability to hedge against inflation. During times of economic uncertainty or rising inflation, gold and silver tend to hold their value or even appreciate, providing a store of wealth that maintains purchasing power. Safe haven assets. Gold and silver are often seen as safe haven assets. They typically perform well during periods of geopolitical turmoil, financial crisis, or when there's a lack of confidence in traditional currencies or equities. Investors flock to these metals, seeking stability and security. Diversification. Including gold and silver in your investment portfolio can enhance diversification. Precious metals often have low or negative correlation with other asset classes like stocks and bonds. This means they can help reduce overall portfolio volatility and risk. Tangible assets. Unlike stocks or bonds, which are essentially paper assets, gold and silver are tangible commodities. You can physically hold these metals in the form of bullion coins or bars, adding a layer of security and independence from financial institutions. Historical store of value. Throughout history, gold and silver have maintained their value over the long term. They have been used as currency and traded for goods and services across cultures and civilizations, highlighting their enduring appeal as a reliable store of value. There are several ways to invest in gold and silver. Physical bullion. Purchasing physical gold and silver in the form of bars or coins is a direct way to own these metals. Bullion coins like the American Eagle, gold and silver, Canadian maple leaf, and South African krugerrand are popular choices among investors. Exchange-traded funds, ETFs. Gold and silver ETFs are investment funds that hold physical bullion or track the price of these metals. Examples include SPDR Gold Shares, GLD for gold, and A Shares Silver Trust, SLV for silver. ETFs offer convenience and liquidity similar to stocks. Mining stocks. Investing in gold and silver mining companies allows you to gain exposure to the precious metals market through stocks. Mining stocks can offer leverage to the price of gold and silver, but come with additional risks related to company performance and operational challenges. Futures and options. Experienced investors can trade futures contracts or options on gold and silver through commodity exchanges. These financial instruments allow for speculation on price movements, but require a good understanding of market dynamics and risk management. Precious metals IRAs. A precious metals IRA allows you to hold physical gold, silver, platinum, and palladium within a retirement account. This option provides tax advantages while diversifying your retirement portfolio with tangible assets. Here's how you can start investing in gold and silver. Research and education. Understand the factors influencing the prices of gold and silver, such as supply and demand dynamics, economic indicators, geopolitical events, and monetary policies. Resources like financial news, market analysis websites, and reputable investment books can provide valuable insights. Set investment goals. Define your investment objectives, risk tolerance, and time horizon. Determine how much of your portfolio you want to allocate to precious metals based on your financial goals and market outlook. Choose investment vehicles. Select the appropriate investment vehicles that align with your investment strategy and preferences. Consider factors such as liquidity, storage costs, tax implications, and ease of buying and selling. Purchase and secure assets. If buying physical bullion, choose a reputable dealer and consider storage options such as secure vaults or safe deposit boxes. For ETFs or mining stocks, open an account with a brokerage firm that offers these investments. Monitor and rebalance. Regularly monitor the performance of your gold and silver investments and rebalance your portfolio as needed to maintain your desired asset allocation. Stay informed about market trends and global economic developments that may impact precious metals prices. Investing in gold and silver can provide valuable diversification, inflation protection, and stability in your investment portfolio. Whether you choose physical bullion, ETFs, mining stocks, or precious metals IRAs, these assets offer different ways to participate in the precious metals market. Remember to conduct thorough research, define your goals, and carefully consider the best approach to integrate gold and silver into your overall investment strategy. Now, let's explore our seventh investment asset: commodities. Commodities such as agricultural products, oil, and natural gas represent essential raw materials in our economy. They play a crucial role in various industries and can serve as valuable investment assets. Today, we'll explore why commodities are important for investors, how they can be used as a diversification tool, and their potential as a hedge against inflation. Commodities are physical goods that are traded on commodities exchanges worldwide. They can be categorized into several types, including agricultural commodities like wheat and corn, energy commodities such as crude oil and natural gas, and metals like gold and copper. Here are some key reasons why investors consider commodities in their portfolios. Benefits of investing in commodities. Diversification. Commodities have low correlation with traditional financial assets, such as stocks and bonds. Including commodities in your portfolio can help spread risk and reduce overall volatility. Different commodities may perform differently under various economic conditions, providing diversification benefits. Inflation hedge. Commodities are often viewed as a hedge against inflation. When inflation rises, the prices of commodities typically increase as well, driven by higher production costs and demand pressures. Investing in commodities can help preserve purchasing power during inflationary periods. Supply and demand dynamics. The prices of commodities are influenced by supply and demand dynamics, which can be affected by factors such as weather conditions, geopolitical events, technological advancements, and global economic trends. Understanding these factors can provide opportunities for investors to profit from price movements. Tangible assets. Like precious metals, commodities are tangible assets with inherent value. Investors can physically own commodities, such as agricultural products, or hold futures contracts representing specific quantities of commodities. This direct ownership can provide a sense of security and independence from financial markets. Let's explore some of the main types of commodities. Agricultural commodities. These include crops such as corn, wheat, soybeans, and cotton. Agricultural commodities are influenced by factors like weather patterns, crop yields, and global demand for food products. Energy commodities. Energy commodities encompass crude oil, natural gas, heating oil, and gasoline. They are essential for global energy consumption and are influenced by geopolitical events, supply disruptions, and technological advancements in renewable energy. Metals commodities. Metals include precious metals like gold, silver, and platinum, as well as industrial metals such as copper, aluminum, and nickel. Precious metals are valued for their rarity, and industrial metals for their applications in manufacturing and construction. Soft commodities. Soft commodities refer to commodities that are grown rather than mined or extracted. This category includes coffee, cocoa, sugar, and orange juice. Soft commodities are sensitive to weather conditions, disease outbreaks, and shifts in global consumption patterns. Livestock commodities. Livestock commodities include cattle, hogs, and poultry. Prices are influenced by factors such as feed costs, disease outbreaks, and consumer demand for meat products. Here's how you can start investing in commodities. Understand market fundamentals. Educate yourself on the fundamentals of commodities markets, including supply and demand dynamics, global production trends, geopolitical risks, and regulatory factors. Websites like Bloomberg Commodities, Reuters, and the U.S. Commodity Futures Trading Commission, CFTC, provide valuable insights. Choose investment vehicles. Decide how you want to invest in commodities. Options include buying physical commodities, trading futures contracts on commodities exchanges, investing in commodity-focused mutual funds or ETFs, or purchasing stocks of companies involved in commodity production. Consider risk management. Commodities can be volatile investments due to factors like weather events, geopolitical tensions, and regulatory changes. Implement risk management strategies such as diversification, setting price targets, and using stop-loss orders to protect your investments. Select a brokerage account. Open an account with a brokerage firm or commodities broker that offers access to commodities markets. Ensure the platform provides comprehensive market data, research tools, and support for trading commodities. Monitor and adjust. Regularly monitor market conditions and adjust your commodity investments as needed based on economic trends, geopolitical developments, and changes in supply and demand dynamics. Commodities offer investors opportunities for diversification, inflation protection, and potential returns driven by supply and demand dynamics. Whether you're interested in agricultural products, energy commodities, metals, or soft commodities, there are various ways to integrate commodities into your investment strategy. Remember to conduct thorough research, understand market fundamentals, and consider the role of commodities in achieving your financial goals. Now let's explore our eighth investment asset, venture capital. Venture capital involves investing in early-stage companies with high growth potential. It's risky but can yield substantial returns. Today, we'll explore why venture capital is an exciting avenue for investors, the risks involved, and how it contributes to innovation and economic growth. Venture capital, VC, is a form of private equity financing provided to early-stage startups and small businesses that demonstrate high growth potential. These companies often operate in innovative or disruptive industries, such as technology, biotechnology, and renewable energy. Here's why venture capital is an attractive investment strategy. Benefits of venture capital investing. High growth potential. Venture capital investments are focused on startups that have the potential to grow rapidly and become industry leaders. These companies often introduce disruptive technologies, products, or services that can revolutionize markets and generate significant returns for investors. Early access to innovation. Investing in venture capital allows investors to participate in the early stages of innovative ideas and technologies. Startups backed by venture capital often bring new solutions to market, addressing unmet needs and creating competitive advantages. Portfolio diversification. Venture capital investments offer diversification benefits by providing exposure to high-risk, high-reward opportunities outside of traditional asset classes like stocks and bonds. Successful venture investments can contribute to overall portfolio performance. Active involvement and expertise. Venture capitalists often provide more than just capital. They offer strategic guidance, industry expertise, and operational support to help startups navigate challenges, scale their businesses, and achieve milestones crucial for growth and success. Here's how venture capital investing typically works. Deal sourcing. Venture capitalists, VCs, source investment opportunities through various channels, including networking events, startup accelerators, industry conferences, and referrals from trusted sources. Due diligence. VCs conduct rigorous due diligence to assess the potential of a startup. This involves evaluating the team's experience, market opportunity, competitive landscape, product or technology uniqueness, business model, financial projections, and exit strategies. Investment terms. If a startup passes due diligence, VCs negotiate investment terms, which may include equity ownership, valuation, rights to participate in management decisions, and potential future funding rounds. Post-investment support. After investing, VCs actively support portfolio companies by providing mentorship, strategic advice, access to networks, and resources to help them achieve growth milestones, secure additional funding, and navigate challenges. Exit strategy. VCs aim to generate returns through successful exits, such as initial public offerings, IPOs, mergers and acquisitions, M&A, or secondary sales of their equity stake in portfolio companies. Here's how you can start investing in venture capital. Understand risk tolerance. Venture capital investments are highly risky and illiquid. Assess your risk tolerance and investment horizon before considering venture capital as part of your portfolio. Network and build relationships. Establish connections with venture capitalists, angel investors, and startup communities. Attend industry events, join online forums, and seek mentorship from experienced investors to gain insights into the venture capital ecosystem. Investment allocation. Allocate a portion of your investment capital specifically for venture capital. Consider diversifying investments across different startups and sectors to spread risk and enhance potential returns. Due diligence and research. Conduct thorough due diligence on potential investment opportunities. Evaluate factors such as market potential, competitive landscape, team expertise, product differentiation, scalability, and alignment with your investment goals. Consult with professionals. Seek advice from financial advisors, lawyers, and experienced venture capitalists to navigate legal complexities, understand investment terms, and optimize your venture capital strategy. In summary, venture capital investing offers an opportunity to support innovation, participate in high-growth potential startups, and potentially earn significant returns. While it involves high risk and requires expertise in evaluating early-stage companies, venture capital can diversify your portfolio and contribute to long-term wealth creation. Now let's explore our ninth investment asset, index funds. Index funds are a great choice for many investors due to their simplicity, low costs, and reliable performance. Here's everything you need to know about investing in index funds. Index funds are a type of mutual fund or ETF that aims to replicate the performance of a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq 100. They offer a passive investment strategy that can yield solid returns over the long term. Here are some key benefits of investing in index funds. Low costs. Index funds have lower expense ratios compared to actively managed funds because they simply track an index rather than relying on active management. This means more of your money is invested rather than eaten up by fees. Diversification. By investing in an index fund, you gain exposure to a broad range of securities within a particular index. This diversification helps spread risk and can lead to more stable returns. Consistent performance. Index funds aim to match the performance of the market index they track, which historically has shown steady growth over time. This makes them a reliable choice for long-term investors. Simplicity. Investing in index funds is straightforward. There's no need to pick individual stocks or time the market. You simply invest in the fund and let it mirror the index's performance. There are various types of index funds to consider. Broad market index funds. These funds track major indices like the S&P 500, covering a wide range of industries and sectors. They offer broad market exposure and are a solid foundation for any investment portfolio. Sector index funds. Sector index funds focus on specific sectors of the economy, such as technology, healthcare, or energy. They allow you to target investments in areas where you expect strong growth. International index funds. These funds track indices of foreign markets, providing exposure to international economies. They can help diversify your portfolio beyond domestic investments and tap into global growth opportunities. Bond index funds. Bond index funds track indices of fixed income securities, such as government or corporate bonds. They provide steady income and can reduce overall portfolio volatility. Small cap and mid cap index funds. These funds track indices of smaller companies with higher growth potential compared to large cap companies. While they can be more volatile, they offer higher growth opportunities. Thematic index funds. Thematic index funds focus on specific investment themes or trends, such as clean energy, technology, or ESG, environmental, social, and governance criteria. They allow you to invest in areas that align with your interests and values. Here's how you can start investing in index funds. Define your investment goals. Determine your financial goals, risk tolerance, and investment horizon. This will help you choose the right types of index funds to include in your portfolio. Choose a brokerage account. Open an account with a brokerage firm that offers a wide selection of index funds. Companies like Vanguard, Fidelity, Charles Schwab, and BlackRock offer numerous index funds and provide user-friendly platforms. Select index funds. Research and select index funds based on your investment goals. Consider factors like the index the fund tracks, its performance history, expense ratio, and the diversification it offers. Websites like Morningstar and your brokerage platform provide detailed information and comparison tools. Invest regularly. Consider setting up automatic contributions to invest regularly in your chosen index funds. This strategy, known as dollar-cost averaging, can help smooth out market volatility and build your investment over time. Monitor your investments. Periodically review your index fund investments to ensure they align with your financial goals and market conditions. Rebalance your portfolio as needed to maintain your desired asset allocation. Investing in index funds offers a simple, cost-effective, and reliable way to build a diversified investment portfolio. Whether you choose broad market index funds, sector funds, or international funds, index funds provide various options to suit different investment strategies and risk appetites. Remember to define your goals, choose the right funds, invest regularly, and monitor your investments to maximize your returns. Now let's explore our 10th investment asset, exchange-traded funds, or ETFs. ETFs are an increasingly popular investment vehicle, known for their flexibility, diversification, and cost-effectiveness. Here's everything you need to know about investing in ETFs. An ETF is a type of investment fund that is traded on stock exchanges, much like individual stocks. ETFs hold assets such as stocks, bonds, commodities, or a combination of these, and they often aim to track the performance of a specific index. Here are some key benefits of investing in ETFs. Diversification. ETFs provide exposure to a broad range of assets within a single fund. This diversification helps reduce risk and can improve your overall investment returns. Flexibility. Unlike mutual funds, ETFs can be bought and sold throughout the trading day at market prices. This flexibility allows you to take advantage of market movements in real time. Cost-effectiveness. ETFs typically have lower expense ratios compared to mutual funds. They also benefit from lower capital gains taxes due to their unique structure, which minimizes taxable events. Transparency. ETFs disclose their holdings on a daily basis, allowing investors to see exactly what they own. This transparency can help you make more informed investment decisions. There are various types of ETFs to consider. Equity ETFs. These ETFs invest in stocks and aim to replicate the performance of a specific stock index, such as the S&P 500 or the NASDAQ 100. They offer broad exposure to the stock market or specific sectors. Bond ETFs. Bond ETFs invest in fixed income securities like government, municipal, or corporate bonds. They provide regular income and are generally less volatile than equity ETFs. Commodity ETFs. These ETFs invest in physical commodities like gold, silver, oil, or agricultural products. They offer a way to gain exposure to commodity prices without owning the physical assets. Sector and industry ETFs. Sector ETFs focus on specific sectors of the economy, such as technology, healthcare, or financials. Industry ETFs drill down further to focus on particular industries within a sector. International ETFs. International ETFs provide exposure to foreign markets, including emerging and developed markets. They can diversify your portfolio beyond domestic investments. Thematic ETFs. These ETFs focus on specific investment themes or trends, such as clean energy, artificial intelligence, or cybersecurity. They can offer targeted exposure to growth areas in the market. Inverse and leveraged ETFs. Inverse ETFs aim to profit from declines in a specific index or asset, while leveraged ETFs use financial derivatives to amplify the returns of an underlying index, often by 2x or 3x. These are more complex and riskier, and are generally suited for experienced investors. Here's how you can start investing in ETFs. Define your investment goals. Determine your financial objectives, risk tolerance, and investment horizon. This will help you choose the right types of ETFs to include in your portfolio. Choose a brokerage account. Open an account with a brokerage firm that offers a wide selection of ETFs. Online brokers like Vanguard, Fidelity, Charles Schwab, and Robinhood provide user-friendly platforms with various research tools. Select ETFs. Research and select ETFs based on your investment goals. Consider factors such as the ETF's performance history, expense ratio, holdings, and the index it tracks. Websites like ETF.com, Morningstar, and your brokerage platform offer detailed information and comparison tools. Buy ETFs. ETFs can be purchased just like stocks through your brokerage account. Decide how many shares you want to buy and place a market or limit order during trading hours. Monitor your investments. Regularly review your ETF investments to ensure they align with your financial goals and market conditions. Rebalance your portfolio as needed to maintain your desired asset allocation. Investing in ETFs offers a flexible, diversified, and cost-effective way to build a robust investment portfolio. Whether you're interested in equity ETFs, bond ETFs, or thematic ETFs, there are options to suit various investment strategies and risk tolerances. Remember to define your goals, choose the right ETFs, and monitor your investments regularly. Those were 10 profitable investment assets for rapid wealth. Remember, all investments come with risks, so it's crucial to do your research and consider consulting a financial advisor. If you found this video helpful, give us a thumbs up, subscribe to our channel, and hit the bell icon to get notified about our latest videos. Leave a comment below on which investment you're interested in and why. Thanks for watching, and we'll see you in the next video.